Warren Buffett finally revealed his latest investment, Chubb Limited stock, ticker symbol CB. Over the past couple of months he had added around 6.7 billion worth of stocks, making it a top 10 holding. The stock itself is up 21% year to date, outperforming the S&P 500. And after the news Warren Buffett has bought shares, the stock went up a decent amount as well. On the 23rd of April, Chubb reported earnings with a beat on EPS and revenue. Buffett loves Chubb Limited for different reasons, and one of them is the dividend. And I understand why, with dividend yield at 1.3% and 8 years of dividend increases. If we take a look at the total returns in the past 5 years, we see that Chubb Limited stock outperforms the S&P 500 slightly. So why does Warren Buffett like this company so much? And could this be the perfect time to buy Chubb Limited stock? Well, by the end of the video I will give you my 3 price targets, so make sure to stay tuned and see how I build up to these price targets. I'm very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So what does Chubb Limited do? Company Ace acquired Chubb in the first quarter of 2016 and assumed the Chubb name. The combination made the new Chubb one of the largest domestic property and casualty insurers, with operations in 54 countries spanning commercial and personal PC insurance, reinsurance and life insurance. Chubb is a high-quality company with AA ratings for financial strength, which could be one of the reasons why Buffett liked this company so much. 52% of the premiums is coming from the US, while 19% is coming from Asia and 17% is coming from Europe. The product distribution also looks pretty good to me. It is very diversified. And here we see that net income was reported at 2.14 billion, up 13.3% year over year. And core operating income was up 20.3% year over year, both looking really impressive. Return on equity, one of the more important numbers for Chubb, was reported at 14.3%, which is an impressive number. Net premiums written increased 14%, which is looking really good. Both P&C and Global P&C have similar increases, but the life insurance segment increased 26.3% in premiums written. The combined ratio also looks pretty good to me. I prefer this number below 19%. If it is at 100%, it means the company needs to pay money instead of earning money. Two other things I want to highlight is the total capital return. Chubb returned 666 million, of which 360 million was share repurchase, and dividends of 350 million. Next to that, Chubb increased its ownership in Watay Group to approximately 85%. And now that we know a bit more about the company, it is time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analyses every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. Chubb Limited stock is a 112 billion market cap company. PE ratio is at 12, indicating they could be undervalued right now. Later in this video I will show you my 3 price targets for Chubb Limited, so make sure to watch until the end. And in the meantime, please let me know your thoughts on the current valuation. Revenue is at almost 52 billion, and in this graph we see that revenue went up really steady and consistent. Margins are going up and down in the long run. Usually this is something that I don't like, but with insurance companies it is a bit different, so this doesn't bother me too much. EPS is looking really good. It is growing quite steady and consistent for an insurance company. Analysis expect that EPS will increase a little under 10% on average per year in the coming 2 years. To me, this looks pretty good. For the revenue, analysis expect also pretty high numbers. On average, you're looking at 7% growth per year, which is pretty nice for a company this big. Return on assets is sitting at 4%, which is a decent number. Return on equity looks really good, and the most important number, return on invested capital, is sitting at 12%, which is a really great number. It is also higher versus the 5-year average, which is a good thing. Current ratio is at 0.25, which is a decent number for an insurance company. Nothing really special to mention here, to be honest. Right now, Chubb has 21 billion in debt. I prefer companies that can pay down at least a big chunk of their total debt with the total cash. Chubb has 7.6 billion in total cash, so they can pay down a decent amount of their debt. But I wouldn't mind to see a higher cash position here. So it is very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And here we see that free cash flow is going up in the long run, which is great. It's kinda steady and consistent. Shares outstanding are decreasing, which is something that I really like. The big increase in 2016 is because of an acquisition, so to me this looks really good. When shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 1.3%, which is a decent number. Annual payout is at $3.64 and payout ratio is around 17%. I prefer 50% or lower, so right now they have 83% left in cash to buy back shares, pay down debt, do acquisitions and all other things. The 5-year growth rate is at 3%, which is a low number to be honest. They increased the dividend for 8 years in a row, which is really impressive. And here we see the dividends paid since 2012. You see that Chubb did increase the dividends at a low pace. However, in the long run, this really adds up. Payout ratio is a very important metric with dividends. It tells you if the dividends are safe. And here we see that payout ratio is coming down quite a lot, which is a good thing. In this graph we see the expected dividends in 2024, 2025 and 2026. Of course this is an estimation and can be highly impacted by results, but it gives you a rough indication. It is expected to increase at a similar rate versus previous years. And overall these dividends look really good to me, but how about the historical returns? I decided to compare CB stock with the overall market, in this case the S&P 500. Next to that I added PGR and Allstate. On the 5-year chart we see that CB outperforms the S&P 500. In total CB returned 108%, including dividends. The S&P 500 is sitting at 101% return. PGR had the highest return here with 200%. On the 1-year chart things look pretty interesting, with all 3 insurance companies beating the S&P 500 massively. Chubb had the lowest return compared to its peers. On the 6-month chart it is the same story. Chubb managed to beat the S&P 500, but had the lowest return versus the other 2. On the 1-month chart it is Chubb with the highest return, beating everyone in this list. Also because of the news with Warren Buffett buying shares of CB stock. Bottom line, Chubb beats the S&P 500 in the long run, and it is having some momentum lately. So could this be the perfect time to buy Chubb stock? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 6, 8 and 10%, based on historical performance, their own outlook, but also because of the analysis. For the profit margin I'm putting in 17, 18 and 19%. For the free cash flow margin I'm putting in 25, 26 and 27%. For the PE ratio I'm putting in 10, 12 and 14. For the price to free cash flow I'm putting in slightly lower numbers. My desired annual return is 12.5% since I can get an easy 10% average annual return with owning an ETF. Right now, Chubb Limited stock is around $274. I hit analyze and we see a lot of green numbers. We have a low price target of $263 to $352. We have a mid price target of $349 to $460. And we have a high price target of $460 to $601. To me, the mid price target is the most justified here, meaning the stock is massively undervalued based on these numbers. So what do you think is the most justified price target here? Let me know in the comments down below. My final conclusion is that you should never buy a stock because of somebody else is buying it, even if it is Warren Buffett. To most people, the most best investor ever. But with that being said, I do think I see why Warren Buffett likes this company so much. Most fundamentals look really good to me, especially the consistent performance is something that I really like. From a dividend point of view, things look pretty interesting as well. They pay a decent yield at a low payout ratio, but the growth rate is the only thing that I don't like here. From a value point of view, things look really interesting. They are capable of growing the company at a steady pace, and based on the price targets, they are undervalued. They also buy back shares at a decent pace, meaning which is really nice. For now, I added them to my buy list. First, I want to do some more research on this company, but it is starting to look very good for sure. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.